Hi, Danya.
Hi guys. Good morning.
Hey guys.
Good morning.
Hola.
We none of us speak Spanish here. So.
No, they're all Saudi. It's not Saudi program.
They what?
It's a Saudi program.
I can't see anybody except you, Rafi, though.
Okay. Morning, Jude. Hi, Talal. Hi.
What's up, Mo?
Hi,
Hello.
sorry.
How's it going?
No issues. We always build a buffer for you guys.
Gallery. Okay.
We're just missing no? Somebody.
1, 2,
Kauthar.
3. He's here.
Jude's here. Danya's here. Mo's here. Mo number.
Daria.
Cool. Just give us 2 minutes, guys, until we gather the rest of you together.
We're quite impressed.
I was impressed with you today. 8:30.
Actually, I was here at 8:10,
Oh, wow.
but then I realized the greenhouse was low at 6. So
Grab
You
the
woke
key
up at
phone.
6?
I didn't even go to the pool.
Oh, sorry about that.
Oh yeah, you usually come at 11. I forgot. Like you.
For good reason. Employee health.
I see that survey. We got
Maybe that should be
Kauthar.
a topic you guys should talk about.
We've got all the teams.
Are you gonna intro first?
Yes, I will.
Okay.
It's recording anyway, yeah.
Yeah.
Yeah, she's seen my message, so let her
Okay.
go for it.
Cool. I guess we'll start, guys. Good morning. How is everybody? Thank you for turning on your cameras. I appreciate that. And make sure your mics are always also turned on because we'd like to make this as interactive as possible, at least this first session. So today we're going to be tackling business and financial modeling with my very good friends, Joanne, Noor, and Marco here. As usual, since you guys don't know them and they don't know you, I'd like to start with the quick intros, like 1 minute. My name is, I am the founder or designer of X brand. And then the guys will introduce themselves and tell you a little bit about what they do. And then we can jump into the session. Does that sound cool?
Yeah. No?
Go on.
So we've got one enthusiastic one. So let's start with the designers first. On top of my screen is Danya. So Danya, you're first. Go for it.
Hi, everyone. Good morning. My name is Danya, and I'm the owner and creative director of Danya Shankar. It's a contemporary and sustainable back brand.
Nice to meet you.
Mo, you're next on my screen. So you're next.
Good morning, guys. My name is Mohammed Bajaba. I am the founder and creative director of Proud Angeles. It's a community-based and lifestyle brand.
All right.
Cool.
Hi, Mo.
Cool. Dalal, you're next on my screen, so you're next.
Hi, my name is Dalal. I'm the co-founder of Cones and Rods, a luxury eyewear company that focuses on sustainability and limited edition production.
All right. Hi.
Cool. Kauthar, you're next on my screen. Go.
Hi everyone. Sorry, I just woke up. Good morning, Hotel Hresh. I am the founder and owner and designer and everything on Craft by Craft. I really want to get to know, so just get off some of this. I am the financial and branding and marketing and all of that from my chest. Yeah. And nice to meet you all.
Nice to meet you.
Cool. Jude, you're next on my screen. Go for it.
Hi, good morning. I'm Jude Fatani. I'm just waiting for my laptop to reboot so I can log in, not from my phone. But my name is Jude Fatani. I'm the creator and designer behind Nam's Life. It was born out of a secret society, and it's a graphic, ready-to-wear lifestyle brand.
All right.
Cool. Dalia, you're next.
Hello,
Hello.
Hi, my name is Dalia Bakhadir. I'm the designer and founder of Human Edit, which is a streetwear brand focused on artistic designs. And the brand is mainly based on collaborations.
All right.
All right, I think we've covered everybody. Now it's your turn, guys. Go.
Yeah, I can
Jojo.
start. Hi, everybody. I'm Joanne. I've been with Shalhoub Group for 8 years now. And currently I co-lead the startup studio of the Greenhouse, which is an exciting project that I'm on. And in my previous life, for the past 7 years before that, I used to handle all the finance of actually in fashion franchise, which are all the fashion stores of Shalhoub Group in the region. And after that, I used to lead the finance department of our department stores, Triano and Plax in Bahrain. So what's great is that my experience is not only finance, it's fashion finance, which is quite relevant for you guys. And I can help you from a finance and from a business perspective as well. Nice to meet you all.
Hi guys, I'm Noor. I've been with the group for 4 years now, managing some of their investments, the venture side, come from a VC background. So I'm super excited to look at all your business models and hopefully we can add some value and give you some recommendations.
Maybe some cash.
My name is Marco. I also recently joined the Shalhoub Group. I'm part of the investments team working with Noor. My background is corporate finance, and I also grew up and lived in Saudi for the majority of my life.
No way, that's so cool. Which one?
Cool. So now that we have our intros, we're more or less ready to start. Just keep in mind, guys, this is going to be recorded, so you can always refer back to it. We'll be sending all the recordings of these sessions to you. Of course, ask as many questions as you like. After the session, you'll be able to book one-on-ones to continue looking at your business models, your financial models, all of that fun stuff. And yeah, I think we're ready to go.
Sure. Just before Noor starts in an introduction, I just want to reiterate that please stop us at any point in time. We try to make it as simple as possible because honestly, what we're doing is basically 3 years of university in an hour and a half, which is definitely not possible. So we know that some of you guys feel much more comfortable with finance, others feel less comfortable with finance and numbers. So we try to do it like the basic and as simple. If you guys have more advanced questions, go for it. If you feel that we're going too quickly, ask us to go a little bit more granular and take a little bit more time to explain some concepts. So yeah, if you want to start.
Any questions? I think we don't. All right, so what we wanted to do was, we know that each of you is building your own business model, slightly different to all the different businesses, but the basics in terms of the finance are pretty much the same. We're going to be looking at the financial statements, 3 of the main ones that we usually cover here in the business, and then we'll look at some of the KPIs, metrics that we like to track. Just make sure that there's a sanity check on your businesses as you go and you develop. And then we'll look at some of the related topics that we can touch on in future conversations as well. And again, I will reiterate, please ask us any questions that you have whenever. You can interrupt us, stop us, and we'll just have a little discussion on and hopefully answer your questions. All right, so I'm just going to jump into it. The 3 financial statements, if you haven't seen them before, are the income statement, the balance sheet, and the statement of cash flows. These are some of our favorite documents to look over. I'm just kidding. They're not as intimidating as one might think. They're rather straightforward, and we will go through each one. We're going to start with the income statement, which is a view of your profit and your incomes and outflows to your businesses. You'll see the expenses listed there. You'll also notice something very specific about the income statement, which is that it covers a specific time period during which your business was operating. You can use the income statement to look at historical, your historical performance and as well to forecast your future, growth and plans. So I think, Jean, go through some of the line items. Any questions before we continue?
Okay.
Super.
I think when it comes to finance in general, everybody does more or less the same things. What we call in accounting is a chart of account. Basically, what they do at the beginning is that every line item has a definition and every line item has an explanation of what goes in it and what doesn't. And some companies are quite standardized across the board. I think the key point here is that you need to stick to how you record your information. So when you review your P&L month on month, when you review and you do the forecasting, it becomes much easier for you to exactly know what goes in every line item. So this is if you want a summarized version of all the different general ledgers that you could be having. But it's important to understand what goes in every line and to remember them and to make sure that every time you book an invoice or you record a transaction, it goes in the same line. You can do amendments as you go, but keep track of them so you understand why the change has been done when you review the performance in a period and the difference from a period to another. So I think we put some dummy numbers here. They're quite, I don't know if you want to call them ambitious or not ambitious. It really depends on your businesses, but we put numbers so we can follow on them. Gross sales, I think that's pretty straightforward, is the number or the quantity of items that you sell times the price of every item that you've put in place. Definitely here when you record the gross sales, it's excluding of VAT. So we're not going to go into the VAT and tax and everything because that's another discussion that's quite extensive. But you need to understand that whatever gets recorded in your P&L is VAT excluding VAT. In your usual transactions, whether you're selling online or offline, customers are going to buy products at a certain price, which records your gross sales. When you decide to go on discount, whether it's in a specific sale period, we think of January, we think of July, or even if you decide to do the discount of onboarding discount online, your first order, you get 10%, whatever that discount, they will be recorded in the discount line. Usually what some companies can have is have different sublines of a discount so you can really track what discount has impacted your business. Is it a sale period discount or is it an onboarding discount? Is it a birthday discount, special discount, whatever you want to call them? But it'll be important to separate your discounts to really be able to understand where is your business being driven from. One thing that we do in fashion is that the usual discount percentage out of your total business or your total gross sales are somewhere between 8 to 15%. We put a 10% as a benchmark. Some brands have a 13%. If you are at the 25% or 35% of your total gross sales, this is where it needs to be flagged to you that, oh, my sale period is driving my business, or my customers are purchasing my items on discount more than they're purchasing on full price. Do I need to review my pricing strategy? Do I need to understand why my customers, is it driven by new customers who are more on onboarding discount or not? There's definitely much more metrics that you can do and more granular reviews that you can do, but this is the first, if you want, key thing that you can see, the flag on your discount and the healthiness of your business, sale period versus full price. Then, so gross sales minus discount definitely gets you to your net sales. Then we have the cost of goods sold. Your cost of goods sold in your case is the production of your products plus your shipments of your product. What we don't usually include in a cost of goods sold is your warehousing and your storage expenses. These don't get included unless you are in the supplier. Yes, I think Mo has a question.
I was wondering, when you do the
Mo,
pricing,
you can ask.
yeah. So you have a shipment that's coming and you have in there like pants, t-shirts, and hoodies, right? And then the shipping cost, let's say perhaps was 10,000, right? How are you gonna allocate the split of the extra cost from the shipping, knowing that the weight of the pants and the hoodies and shirt are different? The way I currently do it, I just split it in between how many units and just allocate 10 real or whatever extra for each shipment. Do you go about it by weight, knowing that this piece is more, I know this is like next level accounting, but I just wanted to know, what do you recommend and how do you guys do it?
So usually this is more from a supply chain and logistics side, but what I would recommend is to do it by value of the item. So if you have some items that are, so you can assume the same percentage. The total value of your product that you brought in were for 1,000 Saudi riyal. You paid a shipping of 100, so it's 10% on top. So you add it on all your products as a 10%. So it's a fair split. If you do it on a value perspective, the lower value items will have a bigger shipping cost allocated to it than the more expensive items. So just assume your total shipment, your shipping cost over your total value, what's the percentage, and add it on top of every item's value. That's how I would do it.
You can also add the logistics.
But this is the landed cost, actually. So it's what calculates your total cost of inventory. So
it's called the landed cost. Is that the term of it?
Landed cost includes customs, shipping. So basically the cost of every item, including all of these costs.
Okay.
Usually what you have, and this is a little bit more, not very finance, more supply chain and logistics, it's an estimated landed cost versus an actual landed cost. But honestly, we wouldn't go into this discussion right now. We can go, if you want, in more of a one-on-one. And maybe we can, I think this is discussion for the supply chain management, supply chain course. Okay, so thank you, Mo, for your question. If anybody has another question, please just raise your hand. So in terms of the cost of goods sold, it works in direct relationship with your gross sales. Why gross sales and why not net sales? I'll explain to you. So your cost of goods sold, every item, let's say you're selling a t-shirt. It costed you in production plus shipping plus customs 100 dirhams. You are selling it for 300 dirham, Saudi riyal. You're selling it for 300 Saudi riyal, and it costed you 100 Saudi riyal. This is the value of that item on your balance sheet. So your relationship is 300 over 100, so 3 times, which means that your COGS out of your gross sales, I just need to do quickly the calculation so I don't say anything stupid, it's 33.33%. And what we have here is a 30% relationship between cost and gross sales. Why we do it on gross sales and not on net sales? Because the relationship between gross sales and COGS is eliminating the sales, the discounts that you have given to people to buy your items. And what you can do is you can compare month on month how your relationship between your cost and your gross sale has been over month and over the years. If you see, for example, that there's a month where your cost of goods sold, or there's a period where your cost of goods sold out of your gross sale has spiked to 45%, while it should have been at 30%, you need to go and investigate what happened in that period. Maybe your shipping expenses were too high. You had to do air freight instead of by sea, for example, or by land, and it costed you much more because you had to rush a shipping expense. Maybe, for example, you had a mistake in your pricing, which meant that your relationship between your price and your cost has been distorted in your system, and you have sold your products for, like, you have entered your products prices wrongly in the system. Maybe you had, for example, high customs. So this is where these triggers are very important for you to understand and to see quite quickly. And the reason why we don't do it at net sales, because in Jan, logically, when you are selling at discount, your cost to your net sales relationship is going to be higher than in March when you are selling at full price. So always review the relationship to your gross sales, because it's not impacted by the sale period or by the discount that you know you have given to your customers. Okay, If you have a question here, let me know.
I've
Sorry.
never seen the designer so concentrated in my life.
And if it's really
It's
too
so
technical, please stop me because I have tendency to go into way too much detail. Yes, Dan.
I have a question, sorry. So you said not to include the warehouse storage cost in the cost of goods sold, but what if that's what I actually kind of do? Like I pay a monthly fee for a logistics company, and it includes warehouse storage and pick and pack and all of that. So technically in each product, when I do costing, I add like, let's say 10 euros for that, for each product.
Danya, do you mind explaining a little bit about your business model? Because it is a little bit different than everybody else's business model, at least the way you structure your ops, just so the guys know, have a little bit of context around it.
Sure. So
like where you production, yeah.
Yeah, sure. So basically, I have like a logistics partner, like an order fulfillment company in Ireland, where basically I produce in Italy, and then I send all of my stock to the warehouse in Ireland, where I store my products there. So I pay a monthly storage fee, and then whenever I have an order that comes onto my online website, it automatically goes to the warehouse or the fulfillment company. They pick and pack the order for me and they ship it off to my customers. So technically I'm paying for like the service of storage and pick and pack and shipping.
Okay,
so
so
to that
usually in the business where the last warehouse stop that is direct to customer, you don't include it in your cost of goods sold. It goes into your warehousing expenses, a different line item that is just a cost. And the fulfillment cost as well, which is your shipping to your customers, is not included in your cost of goods sold. It's included as a separate line, which is fulfillment to customers, which is shipping expense to customer. If you had told me that you're paying for the warehouse cost, which is in Italy, you include that part. Before they transfer it to Ireland, you include the warehousing cost before they transfer the good to Ireland. But the last warehousing stop in general is not included in your cost of goods sold, but a separate expense. As well, this is probably another discussion that can be further like discussed in the supply chain or in our one-on-one. I can definitely 100% check that, but this is usually in accounting, the last warehouse stop is not accounted for your cost of goods sold. Now, if you want to ask me if it's a major issue, no, but if you want to be audited, you want to be compliant with IFRS or US GAAP, they shouldn't be included.
Okay. Even the shipping to customers, like the DHL shipping.
Shipping to customers are definitely another line, because what we talk about cost of goods sold is in direct relationship to your asset value, which is what is the value of your stock today sitting in your warehouse or in your store or whatever that is. And it cannot include a shipping expense that will only be materialized only if you sell that item to your customers.
Okay, got it. Thank you.
Sure. Okay, so net sales minus your cost of goods sold gets you to your gross margin. Your gross margin, because most of you guys, which I think I well understood, all of you guys you are the brand. You're producing and you are selling your products directly. You're not a retailer necessarily, you are a brand, which means that your margins in general, you should aim for like 80%. You should aim for 75%. It really depends on how much discount you give to be able to sell these products to your customers. But at the full price or at the theoretical margin, you should be at the 85%. Now, if you have extra expenses where you do embellishment, where you do things that are a bit more customized and more expensive, you could have a margin around 60 or 65. But usually in fashion, a retailer would have a margin of like 55 to 65%, which if you are a brand, you should aim for 75 to 85% in direct to consumer. Okay, then again, in our one-on-one, we can really understand if you guys are above that or below that, we can dig a little bit deeper to see. I'm just giving you benchmarks of what I've seen in the retail industry. It doesn't mean that it's the way to go, but it just means that you guys can like compare to something and understand why you're different. A stock provision. Now, stock provision is a bit of what we call an accounting adjustment. Why do we take into consideration a stock provision? Because we are in fashion specifically, the value of your product today when you've just produced it is not the same value of your product in a year time. And the reason why, if we're talking about fashionable items, they change and the season change and the desirability of these items will change the more time has passed. So you might tell me some of my products are basic, so the provision calculation of it will be different. What's a provision? Provision is an accounting mechanism that says that this item today is worth 100 Saudi riyal, but because in a year time, I will sell it at a discount most probably, in a year time, I will depreciate the value of this item to 50. And honestly, it's a bit of a complex thing, but what we do is that usually companies have a system or they just do a calculation that they say after 6 months, I will start removing 5% every month of the value of my product. And which means that in a year's time, I would have lost 35% of the value of my product because the probability of me selling it at full price has dropped by 35% in a way. I wouldn't dwell so much on it. It's really just an accounting metric. It's for you to, from the get-go, to understand that the value of your product will change and will depreciate with time. But we usually say in fashion, the first 6 months, you have a full value. After that, you start losing a portion of your value through time. Anyways, if you guys have questions, we can as well go much more deeper and granular, but I don't think you guys need to dwell so much on this subject. A stock adjustment can happen for most of the time is when you do a cycle count, which is quite important in fashion. You guys will see that some products will be lost, some products will be damaged, some products will be stolen, or you will see that some products, for example, you've got a credit note from your supplier on something because they had a defect product and they wanted to compensate you for it. These are all to be accounted for in stock adjustment. So usually 90% of the stock adjustment comes from cycle count. At the end of a period, you say that, okay, I'm going to do a physical count of all my products. This is how many products I found. This is what my system is saying. The difference in value gets recorded as a loss or a gain. Sometimes you find products, sometimes you lose products at the end of a period. And this is where the adjustments happen here. Okay, so just as a quick point, and I think where this is important as well from a retail flag, if you have a gross margin of 67% and you have a gross profit of 64%, it's healthy. The relationship between these two are healthy. Now, if you have a gross margin of 67, but your gross profit drops to 30%, for example, this is a major flag for you guys, because either you've gotten a lot of stolen products and you had to take a big loss on this, or your products are becoming very old and you're not able to sell them and they're just accumulating in your warehouse. Hence, you are taking an accounting adjustment on them. And that means that you need to liquidate the stock and update with new products. So this relationship between both of them is important for you guys to see and to be able to flag. Do you guys have any question at this point, or can I go to easier concepts, which are the regular expenses?
I have a small question. So usually when I order my collection, I do it at 100. And as you know, in clothing, we have 5 different sizes, 6, 4, depending on the brand. And then when we face an issue with the brand, with the production house, usually when I place my orders, I calculate which store is going to get how many smalls, how many medium, how many large. And then when I get the order, he would probably give me 40 L and 5 small, which mess up the whole product assortment. How do you go about such a thing? You just like try to figure out and make up for it, or? And I know it's a supply and demand
So
issue, but like
there's
accounting wise also, like.
Yeah, so there's two things. One, from a finance and accounting perspective, you would only record on your balance sheet what you've received. Usually, you don't record on your balance sheet the stock that hasn't been shipped and hasn't been received by you. So when you receive that item, you start punching in all your products, and you realize that, for example, the supplier has billed you for 100 items, but they've only sent you 99 items. Technically, what you should have in the system is 99 items, and you should have a credit note that you should be receiving from your supplier for that one item that has been missed out. Now, let's say there's a litigation with the supplier and the supplier doesn't want to refund you for this item. You need to take a loss on your P&L, and you can put it in stock adjustment. Or I don't know if it's best practice, but you can, this cost added on top of all the items that you've received. Did I answer your question?
Yeah, I see.
Okay. When it comes to the stock assortment, I would say this is more on a supply chain, and what you need to do to rework your stock assortment in each store. That's really something that you would tackle in the supply chain session. Yeah.
All right.
Okay. So.
Sorry, I'm just eating. That's why.
Something. Okay. Now I'll go a little bit quickly because I know that the major part of any retailer is really sitting in the top lines, which are your discounts, your net sales, your cost, your stock provision, and your stock adjustment. The other lines are quite straightforward. There's a reason why we split your expenses between variable and fixed expenses. Variable expenses are directly linked to you making a sale or not. So it's like your commissions to influencers, for example. It's your commissions to, let's say, when you are in a shop, you have a shop in shop, and you have to pay, for example, 20% to that store for selling your items. Hence, you will only pay that 20% if you sold an item. You're not liable to any fixed cost. So even in marketing, sometimes we put it as a percentage where you monitor that your marketing expense is directly linked to your sales. This is what we call a variable expense. You will only be liable to pay it if you sold. And that comes to a contribution margin. So a contribution margin today is really how much is your margin after you've taken away all the direct costs for you to make a sale. Here we're showing a contribution margin of 41%. Some people have a contribution margin of 5%. Some people have a contribution of 60%. Definitely the higher your contribution margin, the better, because this is what will be left over for you guys to pay your fixed expenses. And after you've done all your direct operations, after you've produced your products, you've fulfilled your products to your customers, you are left with this pool of money to pay all your fixed expenses. And usually the fixed expenses are what you are liable for, regardless of if you are selling or not selling. So this is what we call in retail or in fashion a risk, because they're fixed and you have to pay them in all cases. The likes of your salaries, if you guys have employees in a shop, you have to pay them regardless if they sell or not. If you have a rent, whether it's a rental, a fixed rent in a mall, or it's your rent of your offices, or it's anything related to renting of a space, it's a fixed cost in general. If you have, for example, your website maintenance, if you have developers that you have to pay on retainers, these would be part of your fixed expenses as well. If you're using the likes of Shopify, Shopify has a portion that's variable, which is a percentage of your sale, and has a fixed portion. So you would split that. The variable portion will go in your variable expenses, and the fixed portion will go in your fixed expenses. Depreciation and amortization, honestly, this is if you have any fixtures, for example, for stores or pop-ups, and you've done some fixtures, rails, whatever that is, you can capitalize it on your balance sheet and depreciate a portion of it every period to like reduce its value, because at some point in time, whether it's in 2 years, 5 years, you will have to replace it, which means that the value of that asset that you have after a few years will be gone. And what you're taking is a loss on period basis. Similar concept as the provision, but this is more for fixed asset and not your inventory. Is it well explanatory, or should I dig a little bit deeper when it comes to these concepts?
Ask the
I
gang.
think maybe if they have questions.
Yeah.
at this point.
Okay.
I think we're gonna start having questions.
I'm really I think I took a little bit too much of time for my section, but then I'll wrap it up. So this will come to your total OPEX, and OPEX is the sum of your variable expenses and your fixed expenses. So your operating profit becomes your like if we want to go with your gross profit minus your variable expenses minus your fixed expenses. If they are in negative sign, it's a plus. I don't know why I had to specify this, but just letting you guys know. So it gets you to your operating profit. Here, the operating profit is of 1%. Honestly, in a stable business, you should aim for 5 to 7%. 1% or negative operating profit are usually for businesses that are growing and they need to be invested, or businesses that still need to ramp up their sales. In the case of Saudi, I think you guys have a zakat that usually comes after the operating profit. So you guys can put this after operating profit to get to a net profit. Okay, so this is in 30 minutes what an income statement is all about and how you should read it. I tried to make links to a retail business. We will develop more on that when we go into the KPIs. If you guys have any questions regarding this section, please go ahead and I can answer them before we move into the balance sheet and cash flow.
Guys, just for the record, we'll be sending a calendar for each of the speakers today. So just remember what Joanne spoke about, and that if you want to schedule a one-on-one with her specifically on the income statement, then that will be a person, but we'll send the calendar so you can see their schedules and book one-on-ones specific to your needs. With Joanne?
And I just wanna have a closing sentence from my side. Don't worry too much about not knowing the nitty-gritty of how things work, but focus on understanding how things work on a larger scale. It's important as business owners, you don't need to know exactly what every line means and what everything is being booked where, but you need to be able to read the information that's being given to you by your accounting team or by your finance team. You need to be able to understand, like, why is my margin dropping? I know that my margin should be at 70%. How come for the past 9 months, our margin has been showing 50%? These are the flags that you need to go and look for and understand. Don't focus on the small invoice, where do I book it? Let your accounting team, or if you are doing this externally, or if you have someone internally that's supporting you on that, let your accounting team think into these things and focus on the big lines and to understand versus a budget. Usually you would have a budget and you would have these actual, and you can compare versus your budget. If you have big discrepancies, always ask why. Always try to understand what happened. This is a little bit what I would suggest, and not really be scared about the small things. Okay?
And in the next section, we'll also list out some benchmarks that you can look at on the P&L that can identify these, any red flags you should be looking in your business, whether it was historical or forward-looking. All right, so I think that was amazing. Thank you. I think I learned a lot. Hopefully everybody else did. So we're gonna move from the profit and loss statement, which is basically, which again, to sum it up, is showing you your revenues and costs that were generated during a period of time, right? Certain period of time. Now we're gonna look at the balance sheet. The balance sheet is an overview of everything that the company owns which we classify as assets, and everything that it owes, which we classify as liabilities. Now, assets are going to equal your liabilities plus your equity, shareholders' equity. The most important part of a balance sheet is that it's a snapshot of your business within one period of time. So like we can look at your balance sheet in October and find out what the company's, what debts the company has. So those are the obligations, otherwise known as liabilities. And from the liabilities, we can find out how the company has been financed, whether it's been using debt financing or whether there was equity raised. So you're probably all familiar with fundraising. And so that's one way to get started. And also that links directly into your assets. So your assets are showing how the capital or the cash is being used to generate your revenues and your business overall. So in short, I think what we want to make sure on the balance sheet is that it always balances. So that's just for you a quick tip. Whether you're doing it yourself or whether your auditor is doing it, you're going to have to make sure that it balances. The assets equals liabilities plus equity. If you're looking at
You don't have to convince me.
Okay, cool. Another thing that's quite important is if you took out, so if you subtracted your assets from your liabilities from your assets, you get what is shareholders' equity. Shareholder equity, in other words, is the net value of your company. So minus your debt, minus everything in terms of your assets that you can liquidate, get cash for that. You take the cash, you get rid of your debt, and whatever's left over is literally the value of your company, whether it's your inventory that you've just now liquidated, etc. So that's a very quick and dirty way of valuing, let's say, your company at book value. So that's how the accountants would do it, not how venture capitalists do it. That's a whole different story.
You said that's how you value your business as what? I'm sorry?
At book value. So the accounting method of valuing your business.
And that does not include the brand value, right?
It's not how
actual
you value an investment in the company.
Your brand value is what we call intangible assets.
Okay.
Right? Those are fixed assets that your company has built. You will see something called current assets and non-current assets, current liabilities and non-current liabilities. The most important thing to remember about that, and the easiest way to think about it, is that current assets are assets that can be liquidated into cash within 1 year. And non-current assets are assets that cannot be that will be more longer term and will need more time to liquidate into cash. So imagine if you're buying manufacturing plants, or if you're buying computers and whatnot, that might take longer to liquidate than your inventory, your cash, your current assets. Same principle applies to your liabilities. Your current liabilities are liabilities that need to be serviced or debt that needs to be paid within 1 year. And your non-current is over 1 year. Any questions at this point?
Does the liability include payrolls or in the account payables, or just the actual production?
Liabilities would not technically, yes,
So your payrolls is already deducted from the cash value you have, unless you're expecting you're owing anyone money that you haven't paid yet,
like suppliers.
You put into accounts payables or notes payables.
So those, think about it more as the supply. So what you need to generate revenue. So let's say you've made a purchase, but you haven't paid them yet. That will go into your payable. And this will all show up in your cash flows when you're accounting for net working capital. Is that, I mean, we can go into it more in depth if you'd like to look at on an individual basis. But I think just as an overview, we wanted to share with you what a balance sheet really comprises of, and that's it pretty much. Any questions? I think with that,
And this current balance sheet, as you can see, we have zero on a lot of our long-term assets because we consider the fact that a lot of startups are not putting a lot of investments into actual plants and machinery. But usually, if you look at a typical, like a big company right now, you will have numbers there that kind of fill up. And I don't know if you guys have any questions on the line items, account receivables, unearned revenues, or account payables. But if you do, you're more than welcome to ask now or ask us later at any point in time. All right.
All right.
I think we can get away from this balance sheet.
All right. Get away from it.
Okay, so the last statement we have is actually the statement of cash flows. It basically gives you an insight on what cash you actually have that you can use or that's running in the company. If you realize if you just look at the bottom of the cash flow right now, your ending balance is actually the cash you will see in your balance sheet. So yeah, all these statements are interlinked depending on what line items you're looking at. So the statement of cash flows is divided into three sections. There's the cash flows from operating activities, investing activities, and financing activities. They each represent different movements of cash. And today, the cash flow statement we're showing you right now is using the direct method. It's, I wouldn't say easier, but it kind of is more straightforward. You can look at it, it'll be evident in the operating activities. So if you're starting top to bottom, you can see that cash received from customers is basically your net sales. And after that, you're getting into a lot of line items from within the income statement. Cash paid to merchandise has a lot to do with your COGS, what you're paying for your products. Cash paid to employees. That's where you ask about the salaries. So it's deducted here and it goes into cash in the balance sheet. And you have other operating expenses. Usually these are concentrated on fixed operating expenses rather than variables. And then these are basically the cash flows are like the inflow and outflow of cash that you're currently using to operate your business. That's what you get from your operating activities. Again, the example we use don't really have much into plant and properties or machinery, but whatever you're paying is technically goes into an investment. So you're investing in either your warehouse or office if you're buying equipment, machinery to build your products. They're all considered as investments, and the actual payment you do will go into cash flows for investing activities. Financing activities more has to do with your equity, so the last part of the cash flow statement of the balance sheet, and it's mainly goes into whether you're paying dividends, if you're looking on buying back some of the shares that you already sold out, or if you're getting any cash for selling equity to someone else, an investor. So all that goes into financing activities. It's basically when you look at the statement and you're looking at your ending cash balance, it's you should be able to look at all the change in cash that entered and exited your business at this point in time. and they'll give you a good insight on what you currently have and what tangible cash you can use within the company. I think that's like a quick overview of this statement. I don't know if you guys have any questions about how it works, the line items. Yeah, feel free to ask anything about it. If not, we can move ahead. Again, if any of you have separate questions, you can email us and we can go more in depth and see how this fits into each of your businesses as you're all working in a different way.
Okay.
All right. So I guess these three statements kind of sums up what a business typically needs or would benefit from looking at. And when you're looking into the statements, you can start looking at KPIs that your company is aiming to achieve. KPI.
All right, so like we said earlier, there's some metrics that we track within the retail businesses, and we're cognizant of the fact that you have either online or offline models. So we're gonna go into a number of them that we've seen. Generally, there are others. These are not the set number, but these are the most common for us to look at, and most likely some good metrics to keep in mind when you're building your businesses.
Yeah. So a point on this is that usually finance and business are really hand in hand. Whenever you guys want to analyze your business from a retail perspective, from a supply chain perspective, it's not necessarily where you just look at your financials and that's it. You really need to see how everything interlinks with each other, that things make sense together. So there are some business metrics that you can add on top of all the metrics that we've discussed previously in the income statement. We think of the compounded monthly growth rate. Usually, what do we mean by that in simple terms? It's how much on average are you growing month over month in a specific period of time. So let's say you've been running your business for a year, you have a period of 12 months, okay? Month 12, what is the value that you've achieved in sales? Divided by month 1, which is Jan, what is the value of sales that you've done? To the power 1 over a period of 11 months, because you don't count you don't count January, minus 1. And what it would tell you is how much did you grow every single month on top of the months previously to get you to December's value. Why is it an important metric to see? Because especially when you're starting up a business and you're growing, you need to see if you're growing every single month. And usually a fashion cycle is a little bit like up, down, up, down, up, down. But this is when you're a bit more mature. When you're still in your growing stage, you need to aim to grow every single month on top of each other, because you are still in like awareness campaigns, you're still growing your business. You really want to be able to show traction. And this is what we see is between 10 to 20%. Now, of course, when you're a mature business, on average, you could grow 2%, 1, 3, whatever that is. But at the beginning, you should be pushing for more on that calculation. Then we have the inventory coverage. Inventory coverage.
Can I mention a point on the compounded monthly? So from my journey, my brand, the first 2 years, I haven't been growing. I've been and then the last third year, it's the year when I started growing. And I always kind of came to this realization, first year for fashion brand, it's like bleeding money left and right. So how would that work with this compounded monthly growth rate?
Listen, there's nothing that's called a secret sauce or something that you should have. It really depends on how much you're investing in the brand. But if you're pumping a lot of money and you're putting a lot of money behind your awareness campaigns and your conversion campaigns and you're opening stores and you don't see a month-on-month growth that's between 10 to 20%, this is when you need to see, am I putting my money in the right places? Now, if you've decided that the first year is more of, I want to test and see how things are, and I want to really know what my consumers want, your target will not be 10 to 20%. It really depends on the strategy that you have. It needs to link. That's why we say that business, finance, strategy, everything should be coming together. If I'm a business analyst and I see, for example, that you have a 15% month-on-month growth, but I don't understand your strategy, I cannot know if this is a good number or not. If you've been pumping money, for example, behind it, and your aim was to grow 50% month-on-month, but you're only achieving 10, then there's a gap between what you're putting behind and what you're actually achieving. That's why these are benchmarks, but you should always have a target that you set to yourself for these and really see where you stand versus that target and that objective. Again, so there's nothing like right number or 100%, but these could be just benchmarks where you could aim to get to. An inventory coverage, for example, is what is the value of your stock today divided by what is your average COGS in the previous month. If you are a stable business as well, you would go for the previous 12 months to take all the cycles of fashion. You would take an average of the 12 months previously. If you are a newer business, you would reduce that into 3 months, for example, and you say, I'm going to take only the previous 3 months, and I'm going to see, for example, if you get to an inventory coverage in months of 3, that means that the stock value that you have today will last you for 3 months based on the average COGS of the past 3 months that you've achieved. Now, if you are in a business that's growing and you see yourself that every month you're growing so much from the previous months, you would do it on a forecasted average COGS rather than on a historical average COGS. So you say that because you guys are in production, I would push you more to do on a forecasted average COGS. Is you see that your business has been growing and you say that in the next 6 months, on average, you would be doing 10,000 Saudi riyal in cost. How much inventory should you get to, or what is the inventory coverage that you have today? Is it 3 months? Is it 4 months? Is it 6 months? Usually a retailer in fashion should aim for 3 to 4 months. Now, some of them have 6 months. Because you guys are a brand and you're producing, you should always keep additional 1 month or 2 because for the lead time. So it's a calculation, and I think in supply chain, it'll be much more in depth because they have the right formula. They would tell you how to calculate your inventory coverage, what is the target inventory coverage you should have, considering your lead time of production, your lead time of shipment, how many stores do you have to get to, how long does it take you to ship to these stores. This formula will be given by the supply chain people, but from a finance perspective, 3 to 6 months is usually what we look at as a good indication. A sell-through rate is quite straightforward, and as well, this could be covered much more in depth with the supply chain team. How many units have you sold in a specific period over how many units have you received times 100 to make it a percentage. So if you're saying my spring summer season goes for 6 months, and from Jan to end of July, I've sold 10,000 units, I've received 100,000 units, then my sell-through rate is 10%. Usually in fashion, you should aim at full price to get as much as you can to a 70%, 75% sell-through rate. Maybe the supply chain will give you more accurate benchmarks, but this is what we've been looking at. Then you add another 10% for when you sell on discount as well. If you see yourself in the 30 to 40% sell-through rates and your stock is really not a basic stock item, it's more seasonal. That means that you have only a short period of time to sell it. When you are at the 30, 40% by the end of it, that means you have 60% of your stock that is at risk of sitting in your warehouse and you not being able to sell it, or you have to sell it at a very high discount to liquidate it. So these are the kind of metrics that you guys will be needing to track often I would say monthly, weekly. In Shalhoub, I think they do it on weekly basis where they see every week how much their sell-through has been growing. And usually they put themselves a target of 3 to 4% on weekly basis of additional sell-through points. Again, a topic that can be much more tackled in depth with the supply chain team, because they're the ones who would know the better benchmarks than myself. A value per transaction, it's your total revenue divided by the number of transactions. And this is the way you would link a VPT is with your inventory average value stock. So let's say that your assortment in your inventory is around, on average, 500 Saudi Riyal per piece, but your value per transaction is at 300 Saudi Riyal. This is where you start thinking, I'm selling more of my cheaper items, but I'm investing, and my biggest stock that I have today is in my more expensive items. What is the action that I need to take to readjust that, my stock versus my value per transaction? What incentive do I need to give the frontliners or online for people to buy the more expensive items and for my value per transaction to increase? Okay, unit per transaction is another, it's UPT. I think there's a typo here. It's how many units have been sold in total over the number of transactions sold. Yes, Mo?
What does VPT stand for?
He's raising his hand. Unit per transaction.
No, VPT.
VPT, value per transaction. Value per transaction. It's the same as average basket. So we can call it in two ways, your average basket or value per transaction. You might see the two names for the same meaning. Okay, so the UPT is really, for example, if you have a UPT of 1, it means that your customers are coming in and they're only buying one item. One thing that you can do is incentivize your team. How can they sell an extra item so that you don't need to keep converting more people? You can actually increase their unit per transaction, increase their value as well. So these are the kind of metrics that you guys need to see and that you could be giving as a target to your sales staff or online as like a benchmark that you want to do. We have the runway rate, which is another important business metric. And this is how much cash do you have today divided by the average monthly cash loss. So for example, if you have 1,000 Saudi Riyal today, and on average you've been losing 100, you have 10 months to go. I'm simplifying it. I hope you will never get only 1,000, but this is how you think about it. So I have this much cash. I've been losing on average this much. How much more can I sustain myself spending at this rate? And if you feel that, for example, you're getting to only 2 more months, what are the actions that I can take to extend my runway rate? Do I drop my marketing? Do I try to get, I don't know, to ramp up my sales? Do I try to get, for example, I don't know, rent rebates from my landlords? You start thinking about what are the actions that you can take to increase that runway rate. Finally, that the burn rate is, in relation to the runway rate, is how much have you been spending on average per month? What is your ending cash balance minus your starting cash balance divided by the period of time? So if you've started with 100,000 Saudi Riyal, you've ended with 20,000 Saudi Riyals in 10 months, you spent 8,000 Saudi Riyals a month. So 100 minus 20, that's 80,000 over 10 months, that's 10,000 Saudi Riyal. 8,000 Saudi Riyal. Did I do the right math?
Sorry about that.
3 finance people in here.
So, and then you start seeing, okay, then on average, I'm spending 8,000 Saudi Riyal. Can I drop my spending to 5? Should I increase it to 15? And these are the kind of thought process that you would need to start thinking about. So any questions about these metrics in general?
I honestly love everything here. It's just that the idea, how can we implement it forward for our business? Like, I'm going to open a store in 3 days and I haven't been able to think, how can I set the key the bonuses or whatever, you know, and I'm hiring soon, like brand manager will like, I want to know how I'm gonna challenge him and motivate him, So what would be your advice? And I know that would be one-on-one, but just like briefly from everything here.
So maybe if we can go as well to the offline metrics. So what I would suggest is when you decided to open a store, you've had targets in mind. Did you do an IRR, which is what we call a return on investment, for example? You decided to open a store. What were the objectives of this store? Or you didn't have any at that time?
Increasing sales and brand exposure, definitely that's the biggest objective. Okay,
so some of the exercises that we do is a little bit usually before taking a decision to open a store or not, but now that you're already there, what we can look at is what is the expected traffic you should get into your store. And this usually it's an information that you can get from the mall as what are their ambitions or how much have they seen traffic in the mall. And what you need to do is how much percentage you want to get from this mall traffic. What you can do if you have good connection as well, you can see your neighboring stores. You can go and spend, for example, a week or like a day or 2 days and see the traffic in that area and understand how many visitors do we get on weekdays, how many visitors do we get on weekends, how many people are actually going there and entering the adjacent stores. What are the brands that are next to me? Are they brands that attract traffic, or they're just brands that if you happen to be there, you would go in and see the store? So you need to do a little bit of this assessment to understand what you should expect in terms of traffic into your store. Then you have a conversion rate metric in the store. If you get 1,000 person a day, you need to tell your team from this 1,000 person, you need to engage with them. You need to speak to them without being too clingy. Again, you have to see what your brand DNA is. Do they need to speak to them directly, or do they let them roam around a little bit and then ask them for assistance? What the whole point is that they have to have conversion in mind. They have to say, my daily target to achieve, and we'll get there, is X. If I have 1,000 person to come, so from this 1,000 person, I need at least to have 20 people to sell to 20 people. Once you do these metrics, a salesperson knows what their objective is and what do they need to do to speak to them, to attract them, and to convert them. But it's like a little bit of a reverse engineer kind of things, and you have a top-down approach and a bottom-up approach. But these two metrics are important. A store traffic, usually what we do in stores, we have store counters that are automatic. Some people do it with their store staff where they actually do the manual counting. It depends on how much you want to invest. But I would go, maybe if you don't have enough investment now, with the automatic counter. And it's really more metrics to see how many people came in, how many people was I able to convert on that day. Then let's say, for example, you need to look at productivity per square meter. Your productivity per square meter should have an objective. If your store is strategic and you don't care about losing money, which you shouldn't be doing, then it's a different story. But if you want to make money out of your store, you need to say, how much is my store costing me for me to operate it? Which are the CapEx depreciated over 3 to 5 years, how many people you need to hire for the space and for the complexity of your brand and for the number of SKUs that you have. And then you need to say, okay, my salaries, my rent, my electricity, my water, all of these come up to this number. And you re-engineer how much is the minimum I have to sell to be able to break even. But I don't want to break even. I want to make, for example, 10%. If I make 10%, how much more sales do I need to sell at the margin that you have? And then if in a month you need to sell 100,000, you break it down by days. You can even give targets granular with weekdays, weekends. When you break down the target by day, they are able to say, okay, today is a Monday, I need to achieve 10,000 Saudi Riyal. On a Saturday, I need to achieve 80,000 Saudi Riyal. Why? Because I have a bigger traffic. I'm able to, and people usually come to shop in these days. So you need to really be able to give them these metrics.
Can
Again,
you go
it's,
back to the previous slide? Sorry.
yeah.
So I have a question about the burn rate, which is, if I'm not wrong, which is the cash that actually get burned because you purchase stuff or you test stuff. I have a high burn rate because my brand is a high-end brand. So I basically test fabrics all the year. Each collection, we have a new method, we have a new technique. So we always test the fabric, and we can never actually test on a regular fabric. We are having a leather, so we might use the same leather that we need to test. So I do lose a lot of money only for sampling and testing the fabric. So should I have a specific burn rate each season? Like, should I have like from the total of the whole bulk that I'm going to purchase, or for the whole
Okay.
What's my question? So no, wait, I need to ask you this. So for example, I'm paying 100K to the factory. So should I have a specific percentage of that 100K for the burn rate?
Okay, so basically, I think your question is more linked to the income statement and the cash flow, how much is the sampling taking out of your cash today? And this is something that you can read and see in the income statement. One metric that we look at is sample over total sales. Your samples over total sale, if they are at 20%, and your margin is 60, that means for you to sample, it's eating up 20% of your total margin of 60%. So it's eating up what, 40%, right? 20 out of 60, sorry, I need to do 33%. So if what you need to say is my sampling is costing me so much, but it is linked to my quality. So do I need to sample less, or do I need to make my prices higher? Do I need to push my factory to give me better rates and to have economies of scale and increase my margin or not? I cannot give you a right answer because then sampling is part of your business model, but you need to see if your business model is viable and what are the actions that you can take to sustain yourself. If you're telling me that your sampling is 20% of your total business sales or revenue, that's a lot. If you tell me that your sampling is between 3 and 5% or 5 to 10%, you are able to sustain yourself at this rate, then that's fine because it's part of your model and your quality of your brand. So you need to see where you need to save your money. And that's why one metric that we need to always have in an income statement is every line item out of your total sale. So marketing out of total sale, what's the percentage? Salaries out of total sale, samples out of total sale, fulfillment cost out of total sale. Because when you do it like that, you really can directly spot what's eating up most of your margin. Sometimes, for example, fulfillment can eat up most of your margin because if you need to do cross-border shipping and you don't let the customer pay for it, or you don't want the customer to pay for it, sometimes it can cost you 15 to 20% of your transaction or your value of your sale. That's a high fulfillment cost. You might do it for a few months to test, but at some point you need to drop it to 6 to 8% fulfillment cost. So this is why you look at your income statement on every single line and you see where is your money going, where are you eating up, what's eating up the most of your income. So I would look at it more on an income statement than on your burn rate, because burn rate is more a metric of your total business, how much your total business is eating up cash. You can do it by line.
Sorry, so when you're looking at burn rate, the reason we have not available as a metric is because it really depends on the company. As you said, you guys are testing a lot on some of your products. A lot of companies are heavily invested in R&D and they earn a lot of cash on a monthly basis. So it really depends on how your company is running, some of the goals your company has. But it kind of gets in the way when you're looking at your runway rate, because looking at how much cash you have available and how sustainable your company is, because that's when you run into an issue, and that's where you're gonna have to either raise capital or inject money by yourself. So that's where it really gets tricky. But as a burn rate, again, we put not available because it really depends on each company is different. The goals of the companies are different, and they have different business models.
Okay,
And
did we answer the question?
Yeah, thank you.
All right. Any other question before we can go to the online metrics, if you guys want to present them?
Sure. So Joanne already went through the offline metrics. There are a lot of similar metrics you can measure when you're doing websites or online sales, such as web traffic instead of store traffic, and your conversion rate as well. Obviously, you're expecting a much higher web traffic than store traffic because it's much easier for anyone to visit your website through one click. And you're also expecting a much lower conversion rate. One, you don't have salespeople. Two, because you have such a high web traffic, it's really not easy to get a similar conversion rate in store. But other metrics you can look at and concentrate on are your customer acquisition cost. It's basically your marketing cost, or that you're putting into a new campaign, and how many new customers you're getting from this actual campaign. So you're typically targeting under $50 per new customer, because you're eventually going to have to cover that cost, and you want to see how long you need to keep that customer in order to cover that cost. Another similar metric would be return on ad spend, ROAS, and is basically looking at how much sale you're getting per investment dollar you're putting in a specific marketing campaign.
Yep.
And the metric we put is you typically want to look at a number above 5. If not, it's too low. And
Yeah,
sustainable.
I think on this one is you need to understand in which phase you are of your business. If you are, and it's usually, this number is not something you should target every single month. It's something you should target on a period of time, because definitely some month it's going to be much more competitive in the market for you to be able to get a customer. So you can have months where you are at a 2, and you have months where you are at a 9, and then the average is around 5. But if you have an ambition and a strategy that your point is to increase your awareness, your point is to actually invest and get more people on your website, more people to interact with your business, and not necessarily at this point to convert, you can have, for example, a 3 return on ad spend. But if you want to make sure that your business is sustainable, you should go for anywhere above 5. And this is what can, the relationship here is that the revenue you're making is enough for you to acquire that customer, to fulfill the product to them, and to pay your production costs, at least that. So this is a little bit how you need to think about it. But you shouldn't worry that if a month you are at a 2, what you need to do is then other months you need to probably reduce your marketing dollar investment and really focus on working on organic customers and really getting your customers to come more organically, and really getting them to come from your social pages and do referrals and stuff like that, rather than keep paying on ads. So this is a little bit on that. Similar discussion could be on the customer acquisition cost. You will have some months, especially in sale periods, where your customer acquisition cost is going to be quite high, because if you are competing with the big players in the market and you're all targeting the same kind of customers, you will have to pay a lot more to get them to your website and let them convert on your website. So you might see, for example, your customer acquisition cost at $100 or $150. What ideally you should not be at this level, but in fashion, and if you guys are competing directly with other players, you might see this being a little bit higher. So what you always need to focus on is your organic customers, having an amazing value proposition for your customers, right? Why would they come to you rather than going and buying from another brand? Why? Is it the price? Is it the quality? Is it your brand? Is it because you collaborated with an amazing influencer? You need to really be able to push these attributes rather than focus solely on your ads on Instagram or Facebook or whatever that is. And really try to get more organic customers to your platform. Okay.
I just wanted to ask about the customer acquisition cost or rate. How do you usually, like, I know, like, how can you measure it, like, from a campaign? You know, because I know for a fact my mentor 3 years ago told me that one of the most important things for a brand to be successful is to identify your customer acquisition rate or cost. So if you can elaborate more on that.
Do you want me to?
Yeah, I think Rafi, listen, at the end of the day, I'm not an expert of this. These are more like things that go hand in hand. So I allow someone who's definitely more expert than me, Rafi, to answer that question.
Okay, so when you think of customer acquisition costs, they're super important, right? So again, just to recap really quickly, especially when it comes to online specific customer acquisition costs, you are pulling all the performance marketing money, all the money that you're putting in ads, and those ads have to have an objective of conversion, because you have many different types of ads that you'll be running on performance marketing. And this is your paid ads. And you're going to create content that is specific to making sure it sells versus a content that's more storytelling and inspirational. So you really have to balance that. And so once you set a campaign that has an objective to convert, this is where you're going to start seeing how much money you're spending on those campaigns and how many people you're actually converting. And this is going to tell you how much that costs. Now, what you'll do with this number is you're going to have some sort of a target of performance based on the campaigns and based on how much you want to spend per customer acquisition. And you're going to have some sort of benchmark. You're going to always try to keep it lower than a particular benchmark. And that benchmark is really going to depend on your average value basket, your average price per piece, and all the, let's say, top line revenue metrics that you're going to be looking at in generating revenue. Now, what's important is, depending on your business, and you guys are all in fashion, you're gonna couple your customer acquisition cost with the lifetime value number. And the lifetime value number pretty much tells you in the length of that relationship with the customer. So a customer can be with you for a year, it could be for 2, it could be for 6 months. It really depends on your business model. Let's say F&B is gonna be a lot longer, but if you're buying a car, it's gonna be one time in 10 years, right? That relationship between how much overall value you can extract out of a customer, how much money that person is going to spend versus how much money it costs you to acquire that customer is super important. And we have a ratio in there that's between 1 and 5 that's super important for you. And you're usually trying to target a ratio between the numbers of 3. And why is this an important number? This is going to tell you that they're spending exactly enough money on marketing and in acquiring the exact right customers with the exact amount of value you're going to generate with them over enough time. If that number is too high, that means you're not spending enough money on marketing and you need to pump your marketing spend. If that metric's too low, that means you're spending too much on marketing and you need to reduce that. And that's why you need to keep this. Now, the important point here is to be very consistent with these numbers and always calculate them the same way over a consistent period of time, usually 1 year. And this is going to give you a very, very healthy way of looking at your performance in general on your online store from a financial perspective, not from anything else, but really that the money you're putting in to your performance and ad campaigns is actually driving tangible value, not only to your top line, but to your bottom line. So we will look at return on ad spend. The reason they're saying 5 is a good number is usually that's going to cover all your COGS, all your costs, etc. Anything higher than that, you're becoming obviously more profitable. Anything less than that, you are not even covering your cost of goods sold there.
Yeah, that's true. But again, it depends on your business model. So now that I think about it, to be honest, we should remove the benchmark of the customer acquisition cost. I'll tell you why, because as well, it depends of what is the value of the item you're selling. If you're selling items for $10,000, the item, you definitely would have a higher customer acquisition cost. But if you're selling items for 100 dirhams or 500 dirhams, to be able to sustain yourself, you cannot have a customer acquisition cost of like 500 dirhams, because that means you're spending to get a customer to buy at 500 dirhams, which means this customer is not covering your margin, is not covering your expenses, it's not covering anything. So maybe instead of giving you benchmark, I think the exercise that I would suggest you guys do is go back and look at your statements, your financial statements, and understand for you to be able to be break even, or for you to be able to be a sustainable business and a positive return on your business at some point, what is the target you should get to from a customer acquisition cost and from an ROAS? Because it really depends on the value that you're the value that your customers are paying, and if you are dependent or not on your ads to get customers. If you have high organic customers where you're not paying anything to get these customers to buy from you, you're in a good position. But if you're really dependent on this, you need to make sure that these thresholds are properly accounted for and you have a good target to be in. Okay, so I would suggest we remove this benchmark.
That's fine.
So we don't confuse you guys, because it's really more linked to your value.
As passionate as Rafi about the customer.
I know, that's why I said that he's the right person to explain it.
Usually,
and just to.
I'm sorry. You go, Raf.
No, go for it.
I was saying that reading comes from the analytic reports from the online, and then from the sales report, and then you kind of the accounting and finance.
You'll get that. So you get that in three places. So you'll get those numbers raw from either your performance marketing dashboard, whether that's Facebook or Google, depending what you're running, and that's going to feed into your Google Analytics. Those numbers don't also get reflected in your financial statement. So what you can do is add line items on, how many new customers I've acquired every month, how much my marketing spend is, and you can start actually calculating and going really granular on your financial statements to really see these numbers and track them over time, which is what we recommend you do anyway, and not just rely on your dashboards that are coming from the performance marketing portals and GA. But we'll cover this in a little bit more. And I know, Mo, you wanted to schedule a one-on-one with me. I encourage everybody to do so if you guys like, and we can run a little bit deeper into these metrics. I just wanted to touch a little bit on conversion rate, and then just talk about benchmarks. If you are a new small business, you need to be targeting a conversion rate above 2%. So for all of you, depending on your website, and there's a lot that goes into a good conversion rate. There's a lot of moving pieces, and we'll cover those. But just as a benchmark, anything above 2% in your size of the business is very healthy. If you're an enormous business, I'm speaking like Sephora, Farfetch, etc. If you're doing anywhere between 0.5 to 1, you're in a phenomenal position. But you guys need to be doing double their conversion rate or more in order to be in a quote unquote good position. That's just my.
And one important point is that these metrics should never be looked at in silos. They don't mean anything if you don't look at all of them together and you see which one is your priority right now and which one you want to focus on and which one gives you what. Because let's say you have a conversion rate of 5. It's really good. But if you're getting 100 visitors and a 5% conversion rate, your number of transactions is pretty low. And if your value per transaction is as well very low, that means you're not able to sustain yourself. If you have a 0.5% conversion rate, but you're getting 15,000 visitors and your average per transaction is quite high, that means you have a healthy business that can be sustainable. So in general, all of these should always be looked at together, and they should be looked at versus a target that you've put yourself following a strategy. You define targets, and through these targets, you look at your performance versus these targets. Don't look at them as a value on its own. They don't mean much if you don't have benchmarks or targets to compare to. Okay.
So now, since you mentioned strategy, sorry.
It's bugging a little bit, I think.
You're present.
Where do you at?
No, give it
Okay.
some time because it's bugging on the screen.
Okay, point being, after you set your strategy, basically, if you're just keeping an eye and constantly looking at your KPIs and your targets, then you're able to create a more short-term plan or short-term strategy on what you're trying to improve. So you set your goal, say you set certain metrics you want to reach, and you're constantly looking at how your current performance, and if you're not where you'd like to be, then you can formulate a plan. So how are you going to attack next month and the month after so that you can reach the long-term goal you had for your company or any specific project or target you were currently doing.
Yeah. Again, just to let you all know, these metrics and the benchmarks we've given are more from our experience and what we've seen. Definitely people who are much more in the field, and you guys will have the opportunity to work with them and to ask them this question, will give you much more accurate answers and like really more specific to your own business. So the one-on-one sessions are going to be quite crucial for you. This is really more on that. What I would suggest is before going into any one-on-one session or before going into the supply chain meeting or the next meetings, try to calculate these on your business and try to get your income statement, your balance sheet, your financial statement, all of those. Where are you in terms of cash? Do your metrics, calculate them, and then it makes it easier for you to be able to ask questions with the supply chain team on like sell-through, on inventory. If you have any commercial meeting as well, you can talk about employee productivity, about productivity per square meter, about store traffic, about conversion rates. If you have an online focus session as well, you can talk about all these. Prepare them because it makes it easier for you to engage in this conversation with them.
If you haven't prepared, it'd be easier for us to discuss a plan together and see if we can give you any insights on how to head forward.
I think in terms of other topics that we could be tackling, if you guys are interested, it's something that we couldn't get into today, but there are some other topics that are always related to finance. One, I would say, is budgeting and forecasting. It's something that we can talk about. How can you scale your business? What are the kind of negotiations that you can do? We can discuss them. We're not experts specifically, but we have very good knowledge because we've been in the business for quite some time. And then we can directly for a specific question to the right people. We talk about as well performance marketing. How can you raise capital? We have the two experts, Noor and Marco, sitting with us as well, who can help you specifically on how can you raise capital. So these are just a sample of related topics that you guys can tackle with us on one-on-one if you want to, and if it's interesting for you. Or we can even extend more the discussion on finance and accounting, which I don't know if you guys would be interested, but if you like, anyways. So these are kind of the add-ons discussions that we can have. Okay, do you guys have any question, whatever that question is, related to this or related to another topic that you would want to open soon? Let us know.
I think everybody's
brain dead
a bit. It's been
I have a lot of questions, but I don't want to burn out.
I can feel it. So again, guys, this session was just to kind of touch on the basics of finance and business modeling. We'll be sending out a calendar. We'll obviously send you this presentation as well. So when you start booking your sessions with the respective parties, with Joanne, Marco, or Noor here, just be very specific as what you want to tackle. Do a little pre-prep just to make both your lives easier, and then the guys will take you through any subject that falls within finance and business. I'm sure there's a lot of interesting topics that you guys will discuss, and it should be actually quite a lot of fun. So this is going to be kind of the end of the session. Of course, we're going to send you a survey on this one as well, so we can improve for next time and get used to these tiny little surveys. Of course, they take you like 2 minutes, but it's quite important for us. And if there's any other questions, please reach out to me on Sinead. Tomorrow we have a very fun session with our content factory team. So talking about how to consistently build your brand equity. So that should be fun with Danielle, the creative.
Definitely more fun than ours.
That is definitely more fun.
It starts at 8 as well, so reminder.
I honestly think this is more fun. This is money. This is success.
This is
Seriously, like I noticed within the fashion industry, everybody is keen towards like the fun and content. And I've done that for the first 2 years. That's what I meant. I was going down. Then when I shifted my mentality to focus on numbers, I start seeing the growth in the business. So I really care about this more than content, to be honest, personally. But I have a simple question that I wanted to ask. I forgot. I'll get back to it. Just
think about it. If you can't think of it now, just ping us. We can answer it.
I can text it too.
Cool. Well, that pretty much wraps it up, guys. Thank you for your time. It's been an hour and a half. So
1 second, I have an announcement.
oh, you do have an announcement?
Yeah.
Go for it.
Like so
Announce away.
No, because it's good. So guys, you know we're partnering with Facebook and Instagram, and they're giving all the workshops. Well, they've also gone and recruited content creators that are based in Saudi, and they've actually paired one with each of your brands. So they're going to be working with you to produce content for you in collaboration. All of them have between either 500,000 to 3 million in following, with high engagement between either 20,000 to 70,000. So what I'm going to start doing is booking individual meetings with ye and the content creators so that you can start, you plural, sorry, that you can start working with the content creators themselves. So that's something Facebook and Instagram have gone off and done for you to make the program better and more value. So expect these invites in your calendars. If anyone is working during the day and you can't do daytime meetings, please let me know. Like Kauthar, I know you can't do between 11 and 4, just so I'm not booking times that you won't be available. But yeah, that should be something that's great to work on.
Awesome.
Cool. That's it, guys. You're free to go unless there's any burning questions. I'll end the session now, and I'll send you the recording as well.
Cool.
Go for it.
Yeah. So you're gonna send us this document from yesterday, right?
Correct. We'll send you the documents, we'll send you the recordings, and we'll send you the surveys, and we'll send you the calendar. Well, lots of stuff are coming your way, so don't worry.
All right.
Bye, guys.
Thank you, guys.
All right.
Thank you so much.
Thanks, guys,
Bye, guys.
Bye.
Thank you.
Thank you.
I keep telling her that you